When you retire, you'll get a raise of sufficient income to support your lifestyle without disclosing your assets to an excessive amount of risk. There are a few ways retirees earn in income, such as a 401k, a 403b retirement savings account, Social Security payments, a key source of money, and some retirees are lucky enough to possess a benefit pension. Here are some plans that pay like clockwork. Welcome back to our YouTube channel. In today's video, we will find out 10 investments for retirement. Number 10, immediate fixed annuities. An immediate annuity is the most basic sort of annuity to make a lump sum contribution. It becomes a continuous and guaranteed stream of income for a specified period up to 5 years or lifetime. Withdrawals can begin within 1 year. An immediate annuity may be a contract between a private and insurance firm that pays the owner or beneficiary a guaranteed income that begins soon. It varies from a deferred annuity, which begins payments on a future date chosen by the annuity owner. An immediate pay annuity is also known as a single premium instant annuity, SPIA. Income annuity, or simply instant annuity. A possible downside to an instantaneous annuity is that payments usually end with the death of the beneficiary, and therefore the insurance firm keeps the remaining balance. Therefore, a beneficiary who dies early than expected may not get their money's worth from the deal. On the other hand, a retiree who lives longer can move on. Number 9, systematic withdrawals. A systematic withdrawals scheme enables you to redeem your investments from an opened-end fund scheme in a phased manner. Unlike flat-rate withdrawals, SWP allows you to withdraw money in installments. It is a complete opposite of systematic investments plan. SIP. In a SIP, you funnel savings from your bank account into your favorite mutual fund scheme, while a SWP direct your investments from your mutual fund plan to your savings account. Systematic withdrawal plans allow you to customize your cash flow according to your needs. You can moreover choose to withdraw just the capital gains on your investments or a fixed amount. This way, not only will you still have your monies invested in the program, but you will also be able to access regular income and returns. The money you withdraw can be used to reinvest in some other fund, or it can be held by you in some form of cash. Since you typically can't get your money back from an annuity, once you start paying, you might want to consider an investment account with a systematic retirement plan. Such as an idea is often established in both retirement and non-retirement accounts. Tell the investment company how much to distribute monthly, quarterly, and annually. You stay in control of your wealth, but you don't get the assurance of annuity. Number 8, buy bonds. Bonds represent debt, so if you buy a bond, it means that someone owns your money and they will usually pay you interest on it. When bundled into appropriately diversified portfolios, safer bonds like those issued by federal government agencies and financially strong corporations are often a reliable source of retirement income. A smart approach to investing in bonds is to create a portfolio of different maturities. Using a jaw-dropping technique, bonds have a clear benefit over different stocks. The volatility of bonds, particularly short and medium-term bonds, is lower than the equities stocks. Therefore, bonds are normally considered to be safer investments than stocks. Additionally, bonds experience lower daily volatility than equities, and interest payments on bonds are sometimes higher than the general level of dividends payments. Bonds are generally liquid. Often it is quite easy for an institution to sell a large number of bonds without affecting the price much, which can be more difficult for stocks. Surely bonds are attractive for the comparable certainty of a fixed interest payment twice a year and mixed up lump sum at maturity. Number 7, dividend-paying stocks. Unlike bonds, stocks represent ownership of a company, and as the owner, you can receive regularly scheduled dividends. For example, every quarter, dividends commonly come in the form of cash payments to shareholders. However, not all companies pay dividends, and dividends can stop if a company is financially troubled. In addition, the retiree must own the shares to receive a dividend and, as a result, have market risk. In other words, stock prices sometimes plummet, which could wipe out dividend gains. That's why retirees buying stock for profit should likely limit their exposure to this strategy and stick with the large, stable companies with a long history of dividend payments. Number 6, part-time employment. A part-time employee is a person who works less than specified number of hours during a standard work week. Although most companies define it as less than 40 hours, the Fair Labor Standards Act does not currently distinguish between part-time and full-time work. Consequently, every employer has the authority to set higher or lower standard. However, the United States Bureau of Labor Statistics defined part-time employment as 1 to 34 hours per week. In many cases, a minimum of 20 hours per week is required to be considered part-time worker, and workers are expected to remain on call for additional shifts or seasonal overtime. Number 5. Savings account and CDs. A certificate of deposit CD may be a product given by Bank and Credit Federation that lends a rate of interest premium in trade for the customers agreeing to leave a lump sum deposit untouched for a predetermined period. Almost all consumers and financial organizations give them, although it's up to every bank which CD terms it wants to supply. What proportion higher the speed is going to be compared to the bank's savings and market products, and what penalties it applies for earlier withdrawal. Number 4. Real Estate Investment Trusts, REITs. If you like real estate but don't like owning or holding a mortgage, consider investing in equity. REITs, which buy, sell, and manage commercial properties such as shopping malls and condominiums. REIT shares are purchased directly on exchange or indirectly through mutual funds, which include a basket of securities. REITs generally pay high monthly and quarterly dividends. The land sector has provided diversification benefits to investors alongside its global positions in equities and bonds. REITs offer investors access to a diversified package of highly liquid residential and commercial properties around the world, says Mark Henber, founder and president of Index Fund Advisors in Irvine, California. Number 3. Income producing property. Retired or not, it's nice to check monthly once you rent a house or sell one to someone and keep your mortgage like a bank, but it's not that funny if a tenant or landlord doesn't pay you. And remember, if you own a home, you are at the limit on property taxes and maintenance costs. One idea for retirees is to consider short-term renting of their homes through a home sharing platform such as Airbnb, VRBO. Number 2. Home equity. Home equity is the value of the owner's interest in your home. In other words, it is the current market value of the property minus the lines that are attached to the property. The amount of equity in a home or its value fluctuates over time as mortgage payments are made and market forces affect the current value of the property. You can also leverage your home equity for income by selling the home or getting a home equity loan, home equity line of credit, or reverse mortgage. However, relying on excess amount of worth of your home to finance your retirement is often dangerous, as home values could suddenly drop and reduce or write off your real estate assets. Number 1. Life insurance. Life insurance isn't meant to be an investment, but it can be a welcome source of additional income for retirees who find themselves a little short each month. The safest policy for work is one like whole life or universal life that accumulates cash value on a schedule. Policyholders can access cash reverses through an effective loan or withdrawal. The problem with loans and withdrawals will reduce the policy's death benefit by a similar amount. And if you can't repay the loan, your heirs' death benefits will be used to pay off the loan. And that's it for today's video.